Do you want to learn how to avoid paying taxes legally? Then I want you to stick around till the end of today's conversation because I'm going to save you a ton of money. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. If you are doing as splendid as I am, go grab a cup of coffee or tea or vodka and let's roll. Basically, today's conversation is very interesting. The topic, how do we avoid paying taxes legally? Again, we're doing everything as the law has intended it. We're using methods that the IRS is totally okay with. Number one, you want to invest in municipal bonds, munis. If you buy a municipal bond, basically what you're doing is you are lending money to a state or a local government entity for a set number of interest payments over a predetermined period, right? So this could be 5 years or 10 years. So once the bond reaches its maturity date, the full amount of the original investment is repaid to the buyer. Now, the cool thing here is that interest on munis is exempt from federal taxes and may be tax exempt at the state and local level as well, depending on where you live. And tax-free interest payments make municipal bonds attractive to investors. So you're not paying taxes on income there. Any income you derive from munis is not taxable at the federal level. And munis historically have lower default rates than their corporate bond counterparts. And that makes sense because really, unless the city has pretty poor management, a city with its ability to levy taxes can always repay back bonds that it has borrowed, like the amount borrowed on capital markets. All right. However, municipals typically pay lower interest rates because, yes, if you look at the risk and return continuum, the lower the risk, the lower the interest, the lower the return on investment. So because of the tax benefits, municipal bonds tax equivalent yield makes them attractive to some investors. So the higher your tax bracket, the higher your tax equivalent yield. Number two, I want you to shoot for long-term capital gains. Very important. Investing can be an important tool in growing wealth, right? But an extra benefit from investing in stocks, mutual funds, bonds, and real estate is the favorable tax treatment for long-term capital gains. An investor holding a capital asset for longer than 1 year, that's what we talk about. Whenever I mention the term capital gain, I mean you've held actually the asset for more than a year. So an investor holding a capital asset for longer than a year enjoys a preferential tax rate of 0%, 15%, or 20% on the capital gain, depending on the investor's income level. And if the asset is held for less than a year before selling, the capital gain is taxed as at the ordinary income rates. So if you are in the 35 tax bracket, for example, or 37 tax bracket, and you sell an asset, you sell a stock or bonds before in less than you've held it for less than a year, you're going to be taxed on the profit on the gain at 37%. The third legit way to avoid taxes is something called tax loss harvesting. And if you need to, this is very simple. You need to tax loss harvest your investment. Tax loss harvesting is a technique you can use to proactively harvest available losses to offset gains by selling depreciated securities. What does that mean? In layman terms, it means that you are selling positions that have declined in value since you originally bought them, thereby realizing a loss as defined by the IRS, right? So these losses can be used to offset other gains you have realized during the year. And this, if done pretty well, can help lower your overall tax bill since your tax is paid on the net amount. It's slightly counterintuitive. After all, you're supposed to sell high, right? But the idea is not to eliminate exposure entirely. It's only a temporary sale to reduce your tax bill, after which, if you want to, you can buy back the same stock following a 30-day waiting period. And even if you don't have any gains to offset, the IRS allows you to deduct up to $3,000 in capital losses from your ordinary income each year. In other words, any loss in excess of $3,000 can be carried over and deducted in subsequent tax years. And one thing I want to mention here is that it's important to understand that anyone can deduct $3,000 in losses. It's completely independent of whether you do tax loss harvesting or not. In addition, although you can deduct only $3,000 in any given year, you can carry the losses over to subsequent years until they are exhausted. Number 4, start a business. In addition to creating additional income, a side business offers many tax advantages. And when used in the course of daily business, many expenses can be deducted from income, actually, if you think about it, and thereby reducing the total tax obligation. Especially important tax deductions for self-employed individuals or health insurance premiums, which are available if special requirements are met. Also, by strictly following IRS guidelines, a business owner may deduct part of their home expenses with the home office deduction. We've covered this topic at length in other shows, so you might want to avail yourself of those shows. I'm talking here about the home office deductions. And the portion, for example, the portion of utilities and internet used in the business may also be deducted from income. In order to claim these deductions, you need to actually make sure that you are clear as to the guidelines that the IRS has published in the publication 535. Very important. Number 5, if you want to legally reduce or avoid paying taxes, you can set up an irrevocable life insurance trust. This is kind of cool, and it's if you don't want to leave your family members in a difficult financial situation after you pass away, it's a good idea. It might be a good idea to buy life insurance. So life insurance proceeds generally are not taxable. But after you pass away, they could be included in your estate, which will be subject to taxation. So to avoid having your life insurance proceeds taxed, you can create something called an irrevocable life insurance trust. And you would essentially be setting up a trust and transferring the ownership of it to another person. So the trust is irrevocable because in the future, you will not be able to make adjustment to it without the consent of the trust beneficiary. And by transferring over your life insurance policy, your death benefits will not be included in your estate. So this is kind of best to do this sooner rather than later, because if you die within 3 years of making the transfer, your life insurance proceeds will still be considered part of your taxable estate. Step number 6, max out retirement accounts and employee benefits. If you're trying to avoid paying taxes or you want to reduce your taxes, you need to think about maxing out your IRA accounts, your 401k accounts, other accounts, as well as the employee benefits. So in 2020 and 2021, taxable income can be reduced for contributions up to $19,500 to a 401k or a 403b plan. Those 50 or older can add $6,500 to the basic workplace retirement plan contribution. Those who don't have a retirement plan at work can get a tax break by contributing up to $6,000, and that's $7,000 for those 50 and older to a traditional IRA in 2020 and 2021. Taxpayers who do have workplace retirement plans or whose spouses do may be able to deduct some or all of their traditional IRA contributions from taxable income depending on their income. So this is kind of important. And one thing I also want to say here is that the deduction actually is phased out for adjusted gross income at different levels. In addition to retirement plan contributions, many employers offer a variety of fringe plans that afford employees to exclude from their income contributions made or benefits received under these plans. And what are the benefits here? You have, it includes flexible spending accounts, right? Those are FSAs, educational assistance programs, adoption expense reimbursement, transportation cost reimbursements. You also have group term life insurance up to $50,000, and generally for senior managers and executives, deferred compensation arrangements, the DCAs. And additional benefits from investing in stocks, bonds, and real estate is, as I said earlier, the favorable tax treatment for long-term capital gains. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. I'm just talking to you today about the top 10 tax avoidance methods the IRS is totally okay with. Number 7, you want to use a health savings account, an HSA. Employees with a high deductible health insurance plan can use an HSA to reduce taxes. As with a 401k, the money that you contribute to an HSA before taxes is not taxable. For 2020, the maximum contribution is $3,550 for an individual and $7,100 for a family. For 2021, the maximum deductible contribution is $3,600 for an individual and $7,200 for a family. Now, the cool thing here is that these funds can then grow without the requirement to pay tax on the earnings. Even better, an extra tax benefit of an HSA is that when used to pay for qualified medical expenses, withdrawals are not taxed either. Number 8, you want to claim tax credit. So there are gazillions of tax credits, IRS tax credits that reduce taxes. I'm talking about the Earned Income Tax Credit. I'm talking about the American Opportunity Tax Credit, the Savers Credit, the Child and Dependent Care Credit. So it depends on you. For 2020, a low-income taxpayer may claim credits up to $6,660 with 3 or more qualifying children, $5,920 with 2, $3,584 with 1, and $538 if none. For 2021, the maximum earned income credits are $6,728 with 3 or more qualifying children, $5,980 with 2, $33,618 with 1 child, and $543 if none. The American Opportunity Tax Credit offers a maximum of $2,500 per year for eligible students for the first 4 years of higher education, and the Lifetime Learning Credit allows a maximum 20% credit for up to $10,000 of qualified expenses or $2,000 per return. And I've also talked about the Savers Credit, and this is for moderate and lower income individuals looking to save for retirement. Individuals can receive a credit of up to half their contribution to a plan, an IRA, or an ABLE account. And the Child and Dependent Care Credit can also help reduce your tax credit, and this can, depending on income, help offset qualified expenses for the care for children and mentally or physically incapacitated dependents with credits of up to $3,000 for one dependent and $6,000 for 2 or more for eligible expenses. Method number 9, if you want to avoid taxes the legal way, you want to contribute to FSAs for dependent care. Dependent care flexible spending accounts help parents with child care expenses for children aged 12 and younger, unless disabled, and other dependents such as parents or grandparents that live in your home for at least 8 hours a day. And you can use pre-tax money to pay for your eligible care expense. This is just fantastic. And the cool thing here is that to qualify, you must be working or attending school full-time. Other certain expenses are eligible. You can claim expenses for care at your home, sitters, and daycare, although you cannot claim full-day kindergarten programs. Married couples who file joint tax returns benefit most from this tax break. Married couples who file joint tax returns can contribute up to $5,000 a year, while couples who file separate tax returns can claim $2,500. So if both you and your spouse work, it's important to plan your FSA claims in advance to ensure your combined contribution do not exceed the $5,000 yearly limit. Otherwise, the excess will be taxed. And this is kind of very, very important. And one thing I want to say is that you have 2 types of FSAs. And there are two important differences between the medical FSAs and dependent care FSAs. So dependent care FSAs don't automatically allow you to carry over $500 to the following calendar year. And dependent care FSAs, they're not pre-funded. So it's important to plan your child care expenses in advance to know how much to allocate to your FSA. And similar to traditional FSAs, there is what the specialists called a use it or lose it rule, where any remaining account balance at the end of the year is forfeited to your employer. All right. So enrolling in a dependent care FSA is similar to the process with other FSAs in that it occurs during open enrollment. Number 10, you want to be smart with charitable contributions. So you want to think beyond cash as a donation. You also want to create a larger current year deduction by combining cash and securities. So you're not just donating cash, but you're donating also securities such as stocks and bonds. You can also think about having a donor advised fund for charitable giving. You can make a charitable gift to offset capital gains through portfolio rebalancing. So earlier I was talking to you about harvesting your harvesting your losses. You can also reduce your taxable income by making a charitable gift. You can also take a multi-year approach towards deduction. So if your income is particularly high this year, perhaps as the result of a year-end bonus, or you sold a business, benefited from an inheritance, or otherwise, consider that charitable contribution deductions may be carried forward for up to 5 years. So you are required to claim the maximum deduction possible in the current year. And the deductibility limits are 60% of AGI's adjusted gross income for cash and 30% for long-term appreciated securities. But you can also carry forward any unused charitable deductions for up to 5 more years. And you can also make a charitable donation rather, to offset the tax cost of converting a traditional IRA to a Roth IRA, right? So this could be a good option also. All right, folks, this is really it for today's conversation. I really appreciate your attention. I was talking to you about the top 10 tax avoidance methods the Internal Revenue Service is totally okay with. And what are those? Invest in municipal bonds. You want to shoot for long-term capital gains. You want to tax loss harvest your investments. Start a business. Set up an irrevocable life insurance trust. Max out retirement accounts and employee benefits. You want to use a health savings account. You want to claim tax credit. You want to contribute to FSAs for dependent care. And you want to be very smart with charitable donations. I will see you next time. But until then, remember, stay marvelous.